Right now, the total debt of every government, corporation, and household on Earth has reached $317 trillion. To put that in perspective, if you stacked that amount in $100 bills, the pile would reach beyond the moon, past Mars, and extend 40 million miles into space. Yet there isn't even 1 trillion physical dollars in existence anywhere on the planet. This isn't just a big number. This is a mathematical paradox that reveals something fundamental about how the modern financial system actually works. And once you understand where this money came from, you'll never look at economics the same way again. The question seems simple. If everyone owes money, who exactly is the lender? The answer lies in understanding that money in the modern world isn't found. It's created through debt itself, conjured into existence the moment someone signs a loan agreement. This system is called fractional reserve banking combined with fiat currency, and it means that roughly 97% of all money exists only as digital entries in bank ledgers, not as physical cash. When you take out a mortgage for $300,000, the bank doesn't have that money sitting in a vault. They simply type the number into your account, and new money springs into being, with the only requirement being that you promise to pay it back with interest. The debt exceeds the money supply because the interest itself was never created. If there's $100 in the system and you owe $105 back, that extra $5 doesn't exist anywhere, which means someone, somewhere, must default. This creates a mathematical certainty built into the foundation of modern finance. The system requires continuous growth in the money supply to prevent collapse. Every dollar of debt service demands the creation of more debt just to keep the machinery running, which means the total debt must expand exponentially forever, or the system breaks. To understand where this leads, we need to examine what happened in Germany between 1919 and 1923, when a major industrial economy faced this exact mathematical trap. After World War I ended, the Treaty of Versailles demanded that Germany pay 132 billion gold marks in reparations, roughly $33 billion at the time, an amount equal to 3 times Germany's entire annual economic output. The German government faced an impossible situation. They couldn't raise enough through taxation without destroying what remained of their economy, and they couldn't borrow from foreign creditors who viewed them as a defeated, unreliable borrower. So they did what governments throughout history have done when trapped by unpayable debt. They printed money. The Reichsbank began issuing currency to pay government obligations, and the money supply expanded from 42 billion marks in 1918 to 500 trillion marks by November 1923. The collapse happened in stages, not all at once, which is the crucial lesson. In 1921, the exchange rate was 75 marks to $1, expensive but manageable. By January 1923, it had fallen to 18,000 marks per dollar, and by November of that year, it took 4 trillion marks to buy a single dollar. Workers were paid twice a day because prices doubled during their shift. People used wheelbarrows to carry enough cash to buy bread. Savings were obliterated. If you had 10,000 marks in 1918, enough to buy a small house, by 1923, that amount wouldn't purchase a loaf of bread. The Weimar hyperinflation didn't just destroy wealth, it destroyed the social contract. The middle class, which had saved prudently and followed all the rules, saw their entire life's work evaporate while speculators and those with tangible assets survived. This economic trauma created the conditions for political extremism, and within a decade, Adolf Hitler rose to power partly by exploiting the rage of those who had been financially destroyed. The mathematical mechanism was simple: too much debt with no way to repay it except through currency creation. The debt trap forced money printing caused inflation, and inflation destroyed the currency's ability to function as money. Fast forward to 2025, and we're witnessing the same mathematical pattern on a global scale, but with modern financial engineering that masks the underlying reality. The United States federal debt alone stands at $35 trillion, a figure that has doubled in just the last 12 years and continues accelerating upward by roughly $2 trillion per year. Japan's government debt has reached 264% of its GDP, the highest ratio of any developed nation in modern history. European nations collectively owe $15 trillion. China's total debt, including corporate and local government obligations, exceeds $50 trillion. And emerging markets have borrowed another $11 trillion. Add the corporate debt of the world's businesses, the mortgages and credit cards and auto loans of billions of households, and you arrive at that staggering figure, $317 trillion. This represents 330% of global GDP, meaning the world owes more than 3 times what it produces in an entire year. The response from central banks since the 2008 financial crisis reveals how the system maintains itself. The Federal Reserve, European Central Bank, Bank of Japan, and Bank of England have collectively created over $25 trillion in new money through quantitative easing, buying government bonds and other assets by simply crediting bank accounts with money that didn't previously exist. Interest rates were pushed to zero, and in many cases below zero, meaning savers actually paid banks to hold their money. This wasn't an accident. It was mathematically necessary because the debt burden had grown so large that even modest interest rates would make the debt service impossible. In 2020 and 2021, the U.S. government alone spent $6 trillion more than it collected in taxes, and the Federal Reserve created roughly $5 trillion to purchase the resulting debt. This was the largest peacetime monetary expansion in American history, and it happened in less than 2 years. The inevitable consequence arrived in 2022 and 2023, when inflation surged to 9% in the United States and over 11% in the United Kingdom, the highest levels in 4 decades. Food prices increased by 20 to 30%, energy costs doubled in many regions, and housing became unaffordable for an entire generation. Central banks then faced the impossible choice: continue monetary expansion and watch inflation spiral, or raise interest rates and trigger defaults across the debt-saturated economy. They chose to raise rates, and the immediate result was the collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank in March 2023, the largest bank failures since 2008. The mathematical endgame of exponential debt growth has only 3 possible outcomes, and history shows us what each one looks like. Inflation erodes the real value of debt. Default destroys the debt through bankruptcy and non-payment, or austerity slowly grinds down living standards while attempting to pay debt back. And in nearly every historical case, some combination of all 3 emerges. The global financial system is already showing strain at the connection points. The repo market, where banks lend to each other overnight, experienced a seizure in September 2019 when interest rates suddenly spiked to 10%, forcing the Federal Reserve to inject billions in emergency funding. This happened before anyone had heard of COVID-19, revealing that cracks were forming in the system's foundation even before the pandemic shock. Commercial real estate represents another pressure point, with over $1 trillion in U.S. commercial property loans maturing by 2025. Office buildings are worth 30 to 50% less than their pre-pandemic valuations due to remote work, which means many of these loans are underwater. The buildings are worth less than what's owed on them, and refinancing at higher interest rates may be impossible. The Treasury market, supposedly the safest and most liquid market in the world, experienced unprecedented volatility in March 2020 when even U.S. government bonds couldn't find buyers at any price. The Federal Reserve had to step in as the buyer of last resort, purchasing $3 trillion of Treasury securities in just 8 weeks to prevent a complete market breakdown. Student loan debt in America has reached $1.8 trillion, with default rates that would be even higher, except the government has repeatedly paused repayment requirements. Auto loan delinquencies are rising above 7%. Credit card debt is nearing $1 trillion with average interest rates above 20%. And subprime auto loan-backed securities are showing the same deterioration patterns that preceded the 2008 mortgage crisis. At the sovereign level, developing nations are already defaulting. Sri Lanka defaulted on its $51 billion in debt in 2022. Ghana defaulted on $30 billion in 2022. Zambia defaulted in 2020. Lebanon defaulted in 2020, and Argentina has defaulted for the 9th time in its history. These aren't isolated incidents. They're the leading edge of a debt crisis rolling through nations that borrowed heavily in foreign currencies when interest rates were low. The key difference between now and previous debt crises is that this time the central banks themselves are trapped. In past crises, central banks could lower interest rates and inject liquidity to stabilize the system, but rates in major economies have already spent years at or below zero. In past crises, government debt was modest enough that deficit spending could cushion the blow, but now government debt levels are already at peacetime records. The answer to who is the lender when everyone owes money reveals the fundamental illusion underlying modern finance. There is no lender. The debt is owed to a system that creates money as debt, which means the debt can never be fully repaid without destroying the money supply itself. This isn't a flaw in the system, it's the design of the system. Modern economies require continuous debt expansion, because debt is how new money enters circulation, and without new money, economic growth stops. The truly contrarian insight is that asking who we owe is the wrong question. The right question is what happens when a mathematical system built on exponential growth reaches the limits of exponential growth. You cannot have infinite expansion in a finite world, and $317 trillion in debt represents that limit approaching fast. History doesn't repeat, but the mathematics remains constant. When debt grows faster than the economy's ability to service it, something must give, either the debt or the currency or the political system built on both. We've seen this pattern in Rome, in revolutionary France, in Weimar Germany, in Argentina, in Zimbabwe, and Venezuela. The difference today is scale and interconnection. When Weimar Germany's currency collapsed, it was a national catastrophe, but a local event. When $317 trillion in global debt meets its mathematical reckoning, there's no outside economy to provide rescue, no external lender to bail out the system, because the system is now planetary. The debt crisis isn't coming. We're already in it. The money printing isn't a future threat. Over 40% of all dollars in existence were created in the last 5 years. The question isn't whether the mathematics will resolve, but how, and who pays the cost when phantom money meets physical reality. Understanding this doesn't require conspiracy theories or complex financial knowledge. It requires only the recognition that $317 trillion in debt, in a world where less than $2 trillion in physical currency exists, represents a system built on collective belief rather than mathematical sustainability. And when collective belief meets mathematical impossibility, history shows us which one prevails.